What's going on, guys? Finla with Sal here. In my last episode, I talked a little bit about one of the most important factors in reaching your investment goals, and that was asset allocation. Today, I'm going to be taking that one step further and introduce you to a new practice that, when implemented and done correctly, is actually going to save you a lot of tax money down the line. So hang tight. As always, this video is not to be seen as financial advice, nor should it be construed as such. This video is strictly for educational purposes. With investing, the name of the game is save as much as you can in taxes. The less that you have to legally pay, legally is the key here, then the more you can save for yourself and the more that can be working towards you and your goals. The less you pay in taxes, the more you get to keep in your pocket. It's that simple. If this is your first time visiting the channel, make sure you hit that subscribe button. And if you are already subscribed or returning, please smash that like button, give a comment, and share this with someone who can benefit. So let's get into it. This concept is called asset location. Asset location is the practice of segregating your assets into separate accounts so that you can take advantage of favorable tax rates when it comes time to withdraw from these accounts. The idea of this is to put your future self in the best position to minimize your tax liability so that you end up owing the IRS as little as possible, or better said, less than what you would have had you put those assets elsewhere. But before moving forward with asset location, let's recap a little bit on asset allocation, which was my last video. And if you haven't watched that one yet, make sure you go back and watch it. It's a must. Asset allocation is the practice of separating your monies across different asset classes based upon your goals, your time horizon, and your risk tolerance. So you put yourself in the best position to meet the goals that you are investing for while being conscious of any short-term fluctuations. But just because you have an asset allocation that meets your goals and your risk tolerance and your time horizon doesn't mean there's still room to be a little bit more savvy with how you invest. And that, my friends, is where asset location comes into play. When it comes to asset location, you want to make sure that you're putting your appreciating assets into tax advantaged accounts. The reason you want to do that is because you want to protect your future self and your future gains from being subject to a lot of tax, specifically the capital gains tax rate. And yes, as I've mentioned before, while long-term capital gains are better than short-term capital gains, you know what's better than both of those? This much capital gains. Believe me, if I had a choice of paying 20% on long-term capital gains or paying no capital gains, I pick the latter every day of the week. Conceptually, let me give you an example. Let's say I had stock XYZ and I had the choice to put it in a Roth IRA or an individual taxable account. Now, let's say I chose to put that in the individual taxable account. If stock XYZ does very well and appreciates over the long term by, let's say, 100 grand, then I will be subject to long-term capital gains tax. Now let's compare that to if I had put stock XYZ in a Roth IRA, for example. Now I would be subject on no capital gains tax because I already paid the taxes on it when I had first opened up or invested in the account, better said. On the flip side of that, it might be more appropriate to put less appreciating assets in an account like an individual taxable account, maybe like bonds. The reason you want to do this is because just by having the bonds in the taxable account, you still achieve that diversification and that asset allocation to keep you on goal and risk tolerable, while giving yourself the opportunity to put higher appreciating assets in something like a Roth IRA or a traditional IRA that is tax sheltered. Now, some of the drawbacks of this may be the fact that with an IRA, you can only contribute $6,000 or $7,000, depending on the age, a year in current tax law. Now, I'm not saying you want to over contribute because then the IRS is going to penalize you. But if you can take advantage of as much as that $6,000, $7,000, or however many years you've been contributing, and put that into high appreciating assets, you're going to be setting yourself up for future success. Now, what you can do is just take any excess above what you're able to contribute to your IRAs annually and put that in a taxable account. And if you want to invest that into stocks, that's perfectly fine if it meets your goals and your risk tolerance. But just know that you'll probably be subject to pay capital gains tax on that down the line. Now, conceptually, that probably sounds all fine and dandy. But to illustrate this a little bit more, I'm going to use an example from a company that we should all be very, very familiar with to better illustrate this. And I think you're going to get the idea of how impactful this simple practice can be when it comes to your investing. And to do that, I'm going to be taking you to the whiteboard. So come on. All right, so now we're at the whiteboard, and what we're going to use as an example to better illustrate the purpose of asset location is Amazon. Specifically, we're going to refer to when Amazon IPO'd, which stands for Initial Public Offering. It was in one of my past videos. Go back to one of those if you want to brief up on that a little bit. All right, so let me introduce you to the lovely whiteboard. If you guys know anything about me, and you guys know I used to manage at Vanguard on the brokerage desk, I am a massive, massive fan of the whiteboard. I'm a visual learner. That's just how I learn, and that's how I like to teach as well. So we're gonna go back and use Amazon as an example to illustrate the purpose of asset location. Specifically, we're going to pretend we're in the year 1997 when they originally IPO'd, which stands for Initial Public Offering. It's when the stock became first available to trade to the public. Let's pretend we invested $1,000 back in 1997. If you had invested $1,000 back in 1997, that value today would be roughly about $1.58 million. That's a lot of money for anyone. Let's pretend we have person A who took that $1,000 and bought the assets in a taxable account. And then we have person B who took those $1,000, contributed to a Roth IRA, and bought the stock in that account. How would their realized money in pocket returns differ? Person A, who had bought the stock in the brokerage account, has $1.58 million in their account, and they decide to take it all out. Now, they are going to be liable for paying taxes on that. Now, in this example, I'm going to assume person A and person B both have $0 in annual income, just to help illustrate this picture a little bit better for you guys. But they're going to be liable for paying about $288,000 in long-term capital gains tax. That's going to leave them with $1,292,000 after they pay the taxes, and that's what they see in their bank account. That's still a lot of money, but let's take a look at person B, who knew about asset location. Person B put that $1,000 in a Roth IRA, and they now have $1.58 million in their Roth IRA. Let's say that they are eligible for a qualified distribution of those monies. They do not have to pay any tax on that account, which means they will be depositing $1.58 million into their bank. Now, if you look at person A and person B, they both make out like bandits, but one of them does not have to pay taxes, which is leading to a $288,000 increased value compared to person A. That is the power of asset location. Just because person B was smart enough to put the appreciating asset, or what they thought back in 1997 would be an appreciating asset, in a tax-advantaged account. At the end of the day, guys, it's that simple, and I hope this helps illustrate that picture a little bit better for you. All right, guys, so I hope that helped illustrate a little bit better as to how you can implement asset location into your investment strategies. And I don't want you to think you have to go and pick the next Amazon. Although, if you do, please shoot me a message and let me know, because I would love to get in on that too. But all jokes aside, this practice can be used with any appreciating asset. It's just a matter of picking where you invest in what and what account that is. So with that being said, guys, I hope you guys found some value in today's episode about asset location. If you guys find value in what I'm creating, what I'm trying to educate everyone on, please, please, please hit that subscribe button. Share this with someone, share this with a friend, encourage them to subscribe too. I appreciate all the support you guys have given me up until this point, and I absolutely love doing this. So with that being said, like always, let's keep getting lit. We'll see you guys next time.